Well, good evening, everyone, and welcome to the PayFred Student Loan Forgiveness Program. We're going to cover the student loan repayment. In addition to the student loan repayment, we're going to cover some things that just came out or became more clear with the big, beautiful bill. There's a significant amount of new information that the colleges are not presenting. Most of your guidance counselors are unaware of. But the amount of change, I was talking to a lot of people recently on the college admission side, that the biggest with these new loan limits, it's the biggest change we've had in 25 years. So this is pretty substantial. It's amazing. It's got no press, but it's going to change the way we have to decide on college and how college debt plans into this and how forgiveness all comes together here. So let's get going. And that will be at the end of the program, giving us some updates and things you need to do. And there's specific groups that will be impacted that need to do actions between now and I'm going to say mid-January, and we'll cover those also. So let's get going. So here's tonight's agenda. One, we're going to go through our approach. It's very holistic. We're going to cover the importance of debt structure. We're not going to cover, how the decisions are made, but your debt structure will drive your loan repayment options. And now with the big, beautiful bill, the timing of your decisions on repayment options needs to be done before, I'm going to say, May of 2026. That sounds like a far, distance away, but some people have to do consolidations. There's a whole bunch of things that have to happen. We're going to talk about the different types of forgiveness. There's multiple types. Understanding the use of the income-driven repayment, that's the IDR. We're going to have a lot of acronyms. We're going to show you a list of those coming up. And also what's critical is more and more people are using these income-driven repayment methods, and it's very different than a normal loan that you have, like a mortgage or a car payment. It's based off your income. So manage your tax adjusted gross income on your taxes and who has the debt is absolutely critical. And most of your tax preparers are unfamiliar with this area. And then the last thing, as I just said, we're going to talk about some updates that we just received on the big, beautiful bill and how that's going to impact your college funding decisions going forward. So just a little background on PayFred, nationally recognized expert in this space. You can see who we have the most amount of approved courses with a CFP. We don't sell anything, so our whole thing is just giving people good financial advice. And basically our software is TurboTax for college funding and student loan repayment, and we put it all together in one place. I think this is what really makes us different in the sense that we take a holistic approach. We're, as I just said, your debt structure is going to drive your loan repayment. And that's even going to be more important now with these new loan limits with the big, beautiful bill. But your prior history will impact your future decisions and your repayment and your forgiveness options. What's also changed with the big, beautiful bill that parents and families need to understand is it's no longer each child's is a silo. So in the current existing rules, each child becomes a silo in the sense that you don't have to worry about decisions on that child because there was unlimited loans for parents and graduate school. In the new world is now it's one picture. So your decisions on borrowing money for child one may impact child two. And now if child one wants to go to grad school, that may impact the parents also because in the current rules, parents are not involved with grad school, and now in the new world, they will be. So again, these are the things that people have to be aware of, and this holistic approach is really necessary. And just so you know, we have the software, we have training programs, we do consulting work for individuals and for advisors, and we also have an employee benefits solution. Just a little background on some other programs. This is the third of our series. We may be adding a few more due to these recent changes and the lack of information that's being presented by the colleges, by the press, and by the high schools. But we have one that's going to be really important for paying for grad school. That will be in early December. And so that would be another program I would highly recommend. And then after we get through the holidays, we will also have the Saving for College and Understanding Award Letters. So in relationship to loan forgiveness, there has not been a significant amount of changes in loan forgiveness, excluding two major issues. One is Parent Plus loans. We used to be able to use a strategy for Parent Plus loans. A lot of people didn't know about this or how to use it. And this would allow people that took Parent Plus loans that worked either for a government agency or for a nonprofit to qualify for loan forgiveness. So I had a case the other day. We will save that family close to $300,000 because of the way we structure the debt and what their salary is and things like that. The problem we have is under the big, beautiful bill is that there's no income-driven repayment method for Parent Plus loans going forward. And so that's really important to understand. So that option is no longer available, which is going to put a lot of pressure on parents. In addition, the new RAP program, there's what's called IDR forgiveness. That will go out 30 years instead of the 20 or 25. So they're the two major changes that have happened under the big, beautiful bill that you need to be aware of, that you may have been aware of, may have not been, that you need to look at. Now, we still are waiting for the SAVE lawsuit to be resolved. Right now, if you have that situation, you're not earning public loan forgiveness. Again, about 8 million people got transferred into the SAVE program. There's around 7 million still left in that program. But I would tell you, if you're pursuing public service loan forgiveness or IDR forgiveness, you don't have to make payments, but you're also not earning any credits towards those credit months to end or to get your forgiveness. And so that's also something very important. I just want to make sure you're aware. Everyone probably, if you are either pursuing or getting your FAFSA done, you have what's called an FSA ID. You needed access to that to studentaid.gov web. So what's really good here is the government's done a really good job. There's still separate websites, but it's all filtered through the studentaid.gov website. So you can see your loan data. You can apply for loans. You can get your grant data. You can do the consolidations. You can do repayment. You can fill out your public service loan forgiveness help forms. That is really, really important that you have that, and that we'll be using that. That's where you need to go, especially for loan forgiveness. One big transition that's happened that, again, didn't get a lot of press, but they used to centralize public loan forgiveness at one loan servicer. It was Fed Loan Servicing that was run by FIA, basically. It got then transferred. They left the business. It then went to Mohila. And during COVID, because of all the changes and all the different loan forgiveness programs, they just got overwhelmed. And so what happened is the Department of Ed moved it back to what's called FSA. It's centralized now. So the loan servicers, you can be in any loan servicer's repayment things, but that's all they do. They don't give any advice on loan forgiveness. And you have to actually go through studentaid.gov or what's called the FSA to get any good answers in that new world. So I just want to throw out some acronyms here that you will hear me talk about, and I apologize. This kind of just rolls off my mouth, but income-driven repayment method are the income-driven repayment methods that's driven off your income. So you have income-based repayment, income-based repayment. A lot of times that sounds the same. There's both new and old, and both new and old IBR are the legacy endpoints under the big, beautiful bill. So you'll hear that going forward a lot. There is pay, there is save, there is repay, there is ICR. These are the methods that are all based off of income, which are very different repayment methods. It's based off how you file your taxes, because now it's linked through the IRS, similar to the FAFSA form. And it's based off the how you file your taxes. So an example would be if you have one person that has debt, and now they file their taxes and they're a married couple, and they file their taxes married and joint, which is typically going to be tax efficient, but it's not going to be, in many cases, a loan repayment efficient, because it's going to use both incomes to calculate your loan repayment. And you have to use an income-driven repayment method to qualify for the federal loan forgiveness program. So that's why the IDR methods and the use of those are so important. Then you have public service loan forgiveness. That is probably the most common and most talked about. Just as a note here, if you're thinking you're going to be using public loan forgiveness to fund your child's undergraduate degree, the numbers will not work. Because here's what happens is the student can only get $27,000 in their name from the federal government. The traditional dependent student, okay, in college, over the first 4 years, again, we covered this all in those prior meetings, they can get $5,500 freshman year, $6,500 sophomore year, $7,500 junior and senior year. So that totals $27,000. If you add interest, it usually ends up to be about $30,000. The way the calculations work for public service loan forgiveness, you will not qualify because your income will probably be too high for public loan forgiveness in probably 98% of the cases. So just as a point of reference now, public loan forgiveness will work for graduate school because you're going to take on more debt, and that's the way that's going to structure out. So again, just as a footnote, as we start this program, if you're thinking you're going to fund your child's education using loan forgiveness, that's going to be very difficult. Adjusted gross income, again, that's a term from the tax world. That is line 11 on your 1040, but that is what will be used for the calculation of the income-driven repayment methods. Now, for your high debt people, what happens with the income-driven repayment methods is you, again, looking at a traditional payment, maybe you have a payment that you borrowed $100,000, and your payment, based on how long you took it out for, would be, say, $500 a month. Well, now when you qualify for income-driven repayment methods, and your income is much lower, and that's why these programs have grown, pretty well, is that maybe your payment's only going to be $200. Well, the difference between that $200 and that $500 that you should be paying is called negative amortization. So it's the interest that's not paid. That is an important part under the legacy income-driven repayment methods, okay? That was a very common place, and that's why public service loan forgiveness really worked. It would be very common for us to see someone taking out, say, $100,000, as we just said, and over the 10 years, because they were paying a much lower amount than they needed to, their forgiveness was going to be $120,000. So that's what negative amortization is, and you'll see that on the charts coming up. Now, when you qualify for what's called income-driven repayment forgiveness, or I call it the end-of-term forgiveness, so after the 20, 25, and now under the RAP program, it'll be 30 years, if you have still an outstanding balance under the IRS rules, that forgiveness is taxable in the year it's forgiven. So it comes in as income. Now, for public loan forgiveness, there is no tax bond. There is no forgiveness. If you get forgiven by the end of this year, or you submit the paperwork, you will not have that tax bond, but that will be a very small group. So let's talk about the importance of the debt structure. So the majority of loan forgiveness is directed at federal loans. There are some special programs that different employers will offer, but we're going to primarily focus on the two federal programs. You have to have direct federal loans. So some people, not going to see that often, but it got converted in 2010. But if you went back to school, FFEL loans do not qualify. You'd have to convert the FFEL loans over to direct loans. So again, that's where you can go at that studentaid.gov website. You look at your data. If you see FFEL loans and they have an outstanding balance, you'll need to convert them over. The FFEL loans, this is where, having seen the details, you may see that it will show up on that download or in your file, but if there's no balance, then you don't have to worry about it. So that's an important part. A lot of your people that went back to school or are close to forgiveness, maybe they went to school and it wasn't a decision that the student made. It's typically the school had made a decision because they were both all government-backed loans, but the FFEL loans were a decision that the school had decided, say, we're going to use the FFEL program versus the direct program. In 2010, that was all converted. Now, private loans do not qualify for either of the federal programs. So for public service loan forgiveness and the end of term or the IDR forgiveness, you can't use private loans. Now, there are some new programs that companies are now doing that are called the student loan assistance, which is now part of the big, beautiful bill, that some companies can offer some supplement. They can reimburse you, and it doesn't matter if it's private or federal, up to $5,250. It's a tax code called 157. It's the same as tuition reimbursement. But that's a new rule that was in existence during COVID, but in the big, beautiful bill, that was extended. So when you're now, your child, or you're looking for some options to get your debt forgiven, make sure you ask the employer, do you offer a student loan assistance benefit, and what does it require? So again, the companies can offer a limited amount. They could offer just $1,000 or $2,000, but it's all tax-free on both sides. But there's a vesting period, and again, it will qualify for both federal and private. But for the majority of the things we'll talk about tonight, it is public loan forgiveness, which again, you need federal loans to do that. And some other states offer some programs that are usually through the unique employers. And typically these are states where they're trying to recruit in non-desirable places to live, like, up in North Dakota and things like that, where, you're trying to recruit doctors and nurses and things like that. So that's typically what those forgiveness programs that are offered through the state are given. Just want to make sure you're aware of this with the cost of college and why parents, are seeing this debt grow is, as I mentioned, the student can only get to 27. So think of a school that's $100,000 to go to, and now you want your child to go there per year, but let's look at it on a yearly basis. You want to go to that $100,000 school. The student's only going to get $5,500 freshman year. The rest of that money, over $90,000, is either going to come out of savings, or a parent could borrow the Parent Plus loans. Now, right now, the rules that are in place is they could borrow up to the cost of attendance. So it's $100,000 less whatever financial aid you received is what the federal government would subsidize or allow you to borrow. And the rules, where there's no formal underwriting process, they weren't looking at income. All you had to have was decent credit and no non-payments, so no defaults against your credit history, and you could qualify. And you could borrow $200,000, $300,000. We saw people for $500,000. That is why the reasons these changes are happening. You used to be able to qualify for public loan forgiveness. You still can, but proper steps will need to be taken before 7/1/26. And actually, you would have to start this process, I would say, between now and maybe February, because you're going to have to do a consolidation. You're going to have to be enrolled in the right repayment methods. These are steps that, again, you hear that date of 7/1/26, sounds like far away. That will be really important. You also may hear this term called double consolidation, another strategy that was available, where normal consolidations of Parent Plus loans would have to default into what's called ICR, one of the IDR methods. So income contingent repayment was the method for just Parent Plus loans, but there was a loophole if you did a double consolidation. Now that loophole is still existing, but it's going to be very difficult for people to get the double consolidation done in time for that to be applicable. Now, it won't really matter because of some of the rules in this conversion. We would probably not recommend you do a double consolidation because you're going to eventually move into the IBR methods, which are 10%. In the past, you weren't able to get in there. This is, again, the largest purchase before retirement that we often don't plan for. We don't see this. Again, education has been inflated significantly. Again, and with this, the repayment options that are available to you need to be carried into retirement. So some parents that we have taken on the debt, we're seeing more and more people having their debt when they're finished their schools, are in their late 50s, early 60s. It's significant, and now they're going to carry that into retirement. If you have that situation, this is where looking at the IDR methods will be really, really important, because after 7/1/26, there is no IDR method for Parent Plus loans. Just want to give you a quick view of what is the old and what is the new. So under the old method, there's 4 fixed payments. Then there's 5 IDR methods, income-driven repayment methods. They're just the list here. And in the new, where we're going from 9 repayment methods to 2 for new borrowers. There'll be some legacy options for if you're enrolled in the fixed methods, you'll be able to carry them on. You will not be able to move out of those. And then eventually, if you have done the right things, you'll have access to the different IBR methods post 7/1/26. So again, this is where planning has to be done right now to qualify for the loan forgiveness. Here's one thing, again, the big problem is that the loan servicers, as I said, you have to be using an income-driven repayment method. They cannot give you any personal tax or financial advice. So to lower your adjusted gross income, you need to properly, manage your income. Make sure you file the right way. So do I file married and joint, married and separate? But also, if you have a single borrower, do we put all the retirement, all the pre-tax? Where do we put our dependents? They're all factors that need to go into lowering that payment as low as we can. And the loan servicers who we think can give us the right advice can't address those issues. So this movement to income-driven repayment method it's up about 62% since 2017. They can't give you the right advice to give you the right repayment method. When you now move to the tax and financial advisor side, they don't understand the loan repayment options. They can help you with the tax and things like that, but that's the places where you would go for typical advice that may not be what you expect on the back end. Again, this is why it's so complex. So let's talk about the loan forgiveness, the types. So we have public service loan forgiveness. Again, for that, we're going to talk about those things, but you basically have to work for a nonprofit, a 501c3, or the government agency, and you have to be paid by that organization. So what I mean by that is if you're a consultant working in a school district or for a hospital, your W-2 is coming from the consulting firm and not from the hospital. Even though you're working in the hospital as maybe a contract employee, those hours do not count. It's the EIN on the W-2 that is registered. So that's an important part. As many times, I've been at this, hospital or school for a long time, and they've been either a part-time person and things like that. The IDR end of term forgiveness. This is where you're going to go out, use an income-driven repayment method. This was very common with your dentist or your, some of your doctor or medical professions, your pharmacists, your veterinarians, who have to incur a significant amount of debt to get to their career. And then, they're making substantial money. So they will qualify for that end of term or IDR methods. There are those things. Now, as I said, there are some special programs that have since expired that you may hear about. One was called the Public Service Loan Forgiveness. Again, that happened during the Biden administration, and then the IDR methods. The Biden administration made some good adjustments and changes. That's been a good thing, but it also created a lot of confusion for many borrowers on what they need to do. And during that time frame, which has been a problem, or since COVID, we've not had to make payments, or we've not had an income recertification. Part of the income-driven repayment process, you need to recertify your income. So right now, people are seeing substantial changes in their repayment amounts due to those things of COVID. And then there's death and disability. This is another reason why you want to take the federal loans. If you become disabled and you can qualify, now that process is a longer process, it's almost a year now, you will qualify for loan forgiveness. And if the borrower should die, it will also be an option. So this is, again, another reason why you want to take maybe the federal loans under the new Big Beautiful Bill rules. This is the cash flow you need to do. And with the Parent Plus loan death, if the student should die, their loans, again, they would have those direct SAFR loans, they would be forgiven, and the associated parent loans, Parent Plus loans were taken out for that child, would be also forgiven. God forbid your child dies. If the parent who is the owner of the Parent Plus loan, say you have a parent has Parent Plus loans for two different children, the Parent Plus loans that are associated with that child or those children would be forgiven. Now, their own direct SAFR loans would not be forgiven, but the Parent Plus loans that are associated with them would be forgiven. So there are the types of different forgiveness programs that are available through the federal government. Just want to make sure you're understanding the rules here, because again, everyone tries to simplify this. It's easy to do. So the first thing is, as I said, you have to have direct federal loans. All the new loans from 2010 and on are direct federal loans. So not something you need to really worry about. Now, we have seen situations where They go to, some schools will push some private loans, and we'll probably see more of that because of these new rules. But you want to take the federal loans first. There's different repayment options, loan forgiveness. There's just better options to do that overall. You have to be using an income-driven repayment method. This will be important on this transition period. For the graduating class in 2026, those graduates, they will pay their last bill in February or January or February. They will want to forfeit their grace period and start and enroll in their repayment. So the traditional class would have graduated in May, and then they would have had their grace periods, and they would have started in November, December. With this graduating class in 2026, they want to forfeit the grace period, enroll in one of the legacy programs, so they will have the legacy option under the IDR methods. Again, something that else is no one's talking about. We have to then look at, who are employers. I said, it's not who pays you or where you work, it's who pays you. So again, your W-2 will be the key there. And does that EIN number count? Then 120 on-time payments. They do not have to be consecutive. And you just have to have the right employment. You have to be full-time or two or multiple part-time jobs that add up to 30 hours for qualifying employers. So again, this is where you have to do that work. But the on-time payments are a critical part. What has been improved on the studentaid.gov website is now you can see there's transparency. So once you complete your public service loan forgiveness employment certification for the first time, it will then show you how many credit months you have from a payment standpoint and how many credit months you've earned for employment. So again, it's 10 years. An example, you may go and be a teacher, and now you'll get out of the system, and now you go back, or maybe a nurse is a better example where they're working for a hospital nonprofit. They go and work at a small private practice where they're not earning public loan forgiveness because they're not a nonprofit, and then they go back to the hospital. You can have gaps there, and you will still earn those credits. Now, each year we recommend that they complete the public service loan forgiveness help tool. It's on the studentaid.gov website, and they have to use the EIN number, and it's now electronic. So it's so much easier, and you now just put in your employer name. The only thing you'll need to know is who's signing off on that, the email of that person, and your proper start and stop dates for your employers if you have to backdate or pick up prior months. So again, this is all part of the process. So employment certification, again, this used to be done on paper. I would highly recommend, most of this companies are doing this, but using the public service loan forgiveness help tool. It's on studentaid.gov. Confirm your start dates and things like that. We've had some problems. What we typically do is ask or tell the client to call the employer, confirm their start dates, because sometimes it goes to a third party. Again, use the W-2 EIN number that's on there. It's on your W-2. And if you are going, have to go back and get more data or prior employers, again, get that W-2 for that employer. Then you'll need the email of that person that's handling it. A lot of times with your bigger companies, it's outsourced. That will take, if it takes more than 60 days or it goes to the wrong person, what we usually recommend is they use the help tool and send a separate email from their regular email to that same person to say, hey, I've just submitted my employment certification. Please, can you sign that? Now, when you submit that, what will happen is you'll get an email back from the federal government saying your employer has signed your form, and they'll then add it to your things. Now, this needs to be done each year is what I recommend. And anytime you change jobs. So example would be, the nurse at the hospital, I'm going to go to that private practice. That last employment day, I would recommend that you get that form signed or submit it to them. So at your exit interview, that's done. Teachers are kind of the strange one because you have to know your contract year. So maybe you get done in the summer. So maybe it's like June, but your contract goes through August. Then you would want to wait because officially you still get those July and August months because of the contract year. So teachers are a little bit different in that situation, and you just need to be aware of what you want to do there. But it should be done every year and every time you change jobs or employer. So If you're working at a hospital and you move from hospital A to hospital B, that won't matter. If you move from school district A to school district C, then that will matter. So here's what happens on the employer side, just so you understand that. So you're going to get that authorized email from whoever it is. You'll send it to them. I would, again, recommend you communicate that process to those employees. Then you'll get, again, centralized, or it's outsourced depending on the company. They will have 60 days to do that. If they do not respond in 60 days, it will then disappear. Now, you will periodically get updates to that. It hasn't been updated. This is where knowing the right person and sending a reminder that it's there. Now, sometimes it'll get filtered to junk. You just don't know. But again, understand that annual process by the employer. So I just want to give you an idea of the end of time or IDR forgiveness. Again, this will be just for legacy after 7/1 of 26. It will depend on the plan. Each one's different. It will be 20 or 25 years. Under the RAP program, it's 30 years. The outstanding balance at that time frame after you make those payments will be forgiven. Now, again, you have to be using income to repayment. And in many cases, you have what's called negative amortization, that amount that you're not paying. So the loan balance in many cases is going up. Now, under the RAP program, it will not be going up. That is one benefit to the RAP program. Yes, it's going out 30 years, but you will not have the same forgiveness. You cannot have negative amortization with the RAP program because there's contributions that are going towards it in addition to the negative amortization does not occur. The downside is that in both cases, the end of term forgiveness, excluding this year, it's often called the tax bomb. That forgiveness will come in as a taxable event, as taxable income. So say you're making $100,000, your loans have an outstanding balance of 110, your tax bracket for that forgiveness, you will be now at $110 or $210,000 because you'll have the $100,000 of income and the $110,000 that was forgiven will come in as 210, and that amount will be taxed. So again, you have to plan for that. The upside or the downside that you want to look at it is that during that time frame, you have that negative amortization. Now you're only going to be paying, say, 20, depends on your tax bracket, of the amount that's outstanding. So again, that's why you would go through this. Again, many people were using the income-driven repayment methods for the proper repayment in retirement. We have a lot of people, and they will, again, have to do the right things here. But this is where this may be a tax to the estate. So when you die, if you've now taken it and used the income-driven repayment methods and die, what happens is it will come in against your estate. So it's not going to, when you die, if you're not familiar with this, there's a final tax return for the amount of time you were living. And then at the time of death, you start a whole another tax return called your estate return. It's going to go against the estate return. So again, if your estate has no value, it's unclear what's going to happen with the IRS if they're going to go after the beneficiaries in other places. But at this point in time, we don't know. So I just want to give you a sense of how it looks in this case here. So here's public loan forgiveness. The yellow is the negative amortization. So this person has about $71,000 of debt. They have 48 months of repayment already classified here that's qualified. And the blue line is the interest being paid. The yellow line is the negative amortization. And then the red line is what their monthly payment is going to be over time. So we're planning that amount. So here we can see that over this time, there'll be $26,000 that'll be charged in interest to the loan. They'll only pay $5,800 of that. And now that $72,000 will grow to $92,000. And the whole amount, the $92,000, would be forgiven once you reach the 120 on-time payments and have the proper employment, and there's no tax exposure. So that's the major advantage of what loan forgiveness can give to you. Now, when you do this, you have to look at your work time of how much time you're going to do. It is a commitment that you have to make and know. Now, it's not saying you can't. If like you're a teacher or you're a nurse, you're not locked into the same job. You can, change from hospital A to hospital B, go to a different school system. You can do all those things. You just have to be employed by the federal government, or sorry, any government agency as a full-time employee, or, again, part-time, multiple places, or the nonprofit. So again, swinging between those, and you have to need to check that out when you make those decisions and change of careers and things like that. The end of term forgiveness, as you can see here, it goes out for a much longer time. The same situation, they pay a lot more money. There would be much more negative amortization, but now we see that tax bill that I told you about. So they're going to have $125,000 forgiven, but they're going to have a tax bill. So again, that payment's a lot less than you should be paying. That yellow line is what you should be paying, or those yellow bars. And so the amount you're saving is substantial. I mean, it's almost $90,000 that you're saving by doing the end of term forgiveness. Again, it's typically used by your high net, high debt people or high income people that were using this process, your dentist, your veterinarians, your pharmacists. Now, again, with the big, beautiful bill, anybody that's either near this position or in it will have to, especially save people, will have to make decisions before 7/1 of 26 to be grandfathered in. Again, depends on the situation. You need to take some steps now. As I mentioned earlier, what's really important is understanding your tax filing. It's based on when the loans are. So the confusion on the loan repayments, and this gets into that legacy planning where we're going to eventually move to new IBR and old IBR will be the existing legacy plans after 7/1 of 28 is the planned date of that. If you have loans prior to 7/1 of 14, you will have to use old IBR. Now that's a downside because the old IBR is not as kind as new IBR. They're the rules. I know people are going like, well, why aren't they the same? I can't give you an answer to that, but you just need to be aware of that. You have to have the federal loans, as I said. It will be then dependent on the borrower's AGI and their tax filing method. So that is absolutely critical. The family size of who claims what dependents. Again, that is very important. And then it will use a percent of the AGI to calculate that number. It will be used for the loan forgiveness. Again, you have the negative amortization. So again, the tax filing decisions here are all linked together, and the timing of your tax decisions. So as I said earlier, that when you qualify for the income-driven repayment, we haven't had this during COVID. There hasn't been income certifications. Every year, your income is recertified and your payment amount is adjusted. So that can go up and down depending on what your income does. But now that's where your tax filing decisions are important. Now, under the income-driven repayment, you have an IDR certification date. That's your income going to be done. You'll get notification 90 days in front of it. And in 30 days, they'll look and see if you have tax information on file if you've signed up for that. I highly recommend that you sign up for that, and that way you can do the proper tax planning and only have to handle this once a year. So example, if you have an anniversary date and say your prior year, it'll be based on your prior year's submission or a recent pay stub, whichever you supply to them. But you can do maybe a file extension and keep a lower payment for an extra year. There's some additional strategies that are important to understand because of how you file your taxes and when you file them that can be beneficial. When you do this calculation on the legacy programs, again, the WRAP program has a different type of calculation, but it uses what's called discretionary income. Its pre-tax benefits can lower that adjusted gross income. This gets into the tax planning. So say you have a single borrower and both the husband and wife are contributing to the retirement plan, assuming you don't forfeit any matches, the person that has the higher debt should put in all the retirement dollars, lowering that AGI and making their monthly payments lower. Again, if you file jointly, it's going to use both incomes, and then you'd have to actually wait another year. As I said, each year you can turn on this automation of the IRS. At some point in time, I would recommend you do that. That way you only have to do this once, because especially now with this legacy timing, if you miss the IDR recertification, what will happen is you'll be thrown out and you may not be able to get in. We don't know what that's going to look like. It is a new area for the tax professionals. Typically, it kind of contradicts what they're there for, we get pushback all the time from them, is their goal here is to lower your taxes. So when you file married and separate versus married and joint, there's typically an increase in your taxes. Now, what you're going to be saving on your repayment will typically offset that tax penalty. So again, these are certain things that you need to be aware of and the pushback you may get as you go through this. The WRAP program is a little bit different. It's still going to use the AGI, but the calculation does not use the discretionary income, which includes a portion for the poverty table. Just want to give you an example of what this looks like with our system of how we can see this. So we can see what your estimated taxes look like. It's very simple. And this is where you can bring something in. But you can see here, we're going to use pay in this situation. If we file married and joint, which was tax efficient, okay, and maybe they're going to pay maybe $200 more in taxes for the year, on a monthly basis, if we file married and separate, we'd be paying about $179 versus $759. So this is the advantage you have by filing married and separate, on top of your earning credits toward the loan forgiveness that we just saw a minute ago. So we're saving money not just on the monthly payments, but we're also saving money on the back end with the forgiveness. Just give you a quick view here. This is that amounts where the forgiveness, there, the end of term forgiveness. Again, public loan forgiveness is after 10 years, 120 on-time payments. Again, it's 120 on-time payments. That may go out 10, 11, 12, 13 years because maybe you took time off to start a family, or you only worked part-time, or maybe you left the proper employment for some period of time. Does it qualify for public loan forgiveness? All the legacy programs do, and so does the WRAP program. Again, this will be the only IDR method available for new borrowers. And here again, you can see the timeframes. Here is as example, here's what new IBR is 10. Old IBR, so just the date of having older loans is going to make that payment higher. I know it sounds unfair, but that's the way it is. Again, for many people, we had 8 million people get enrolled in SAVE. That was found basically unconstitutional. It's still in the law, in the court system, but I think it's going to be found unconstitutional because of the cost. It kind of falls into the same reason why the forgiveness was not allowed, that one-time forgiveness amount that was talked about, knocked down by the Supreme Court. The SAVE program was going to cost more than that, and it needed congressional approval. That's why it got hung up or got stopped. I'm not saying that's fair or not, but what the Supreme Court basically said is the president does not have the option to create a program that's going to cost the taxpayers. They make changes all the time, but it had to be approved by the Congress. And we've seen that argument on both sides of the table. So, and here is, I think on the next slide, we're going to see what the difference is on the WRAP program. Here's how the WRAP program is going to work. So there's a piece under the current system that looks under the legacy IDR that has a piece of the poverty table. You get a portion of that to lower your payments. Your AGI number is going to dictate the percents. Now, that could be a benefit in some cases. It also could be, could hurt you a little bit versus the legacy. This is where running those numbers and seeing where you need to be between now and the end of the year is important. So that concludes the pieces of, if there's any questions on public loan forgiveness or loan forgiveness. Again, you can see the integration of how you have to manage your adjusted gross income because it has to use an income driven repayment method. I know we went into some more details than normal, but I just want to do that. So I'm going to answer a few of the questions here. I hit traffic. Yes, there will be a recording. I think it's only available for, until Sunday. Sunday night, I think, is when it goes in. All right. Barbara, if I make the last payment in 13 months, will that forgiveness be taxable to me? So again, on the forgiveness piece, it will depend on what forgiveness program you're pursuing, Barbara. So if you're going after public loan forgiveness is tax-free. All right. If you're going after income-driven repayment forgiveness or end-of-term forgiveness, that is taxable. You would have had to have your forgiveness granted before 12/31 of 25, because that was a COVID rule that was put in place under the CARES Act. So that's it is public service loan forgiveness. So again, there could be another opportunity, that chart that I was talking about on studentaid.gov. If you've submitted your employment certification, it sounds like you know that you've done that already because you know you only have 13 months left, is you can see if you're enrolled and saved for part of that time frame, you may be able to buy back some months before then. So that may be an option for you. You can see what months you will have an eligible in payment and an eligible employment. It will show up on the chart. You can go and see that. And you could there is a current buyback program that's available. It does not cover the SAVE program. At least right now, there's talk that will, but at least right now, that may be an option to move up your time frame 13 months if you have some months going back. That may move your time frame up. So again, something you may consider. Alrighty, that looks like it's all the questions we had on that. Let's see here, did I qualify that? Okay. Here are some upcoming programs that you need to be aware of when you look at the income-driven repayment methods for loan forgiveness. So to be enrolled in a legacy IDR method, you have to make the right steps before 6/30, and that will depend on each situation. So an example would be, maybe you're enrolled in the SAVE program as a current borrower. Well, that could be as simple as completing a change of repayment methods, and that is pretty quick to do. Now, which one do you need to select is a whole different scenario. So if they've gotten married, again, if you maybe got married during COVID, we've had any income recertifications, and now you file married and joint, well, your prior payment was based off 2019 income. Now it's 2025, and plus you got married and your spouse doesn't have debt. So maybe you were making $70,000 and now you're at $200,000 because you filed married and joint, plus you got raises. Your new payment's going to be based off the $200,000 if you don't take the right steps on your tax filing decision and changing your repayment method. So I would recommend that you do not wait until the last minute. It's going to take time to process. Now, on the Parent Plus side, you'd have to do a consolidation. Again, each situation is going to be different. Any loans after 6/30 of 26 will only have access to the tiered standard and the WRAP program. So the legacy options, again, if you don't do anything, it becomes a problem in my eyes. It doesn't give you the flexibility, and each case will be different based on your income. So as you saw the difference in the tier programs, in the WRAP program, if you can manage your income to a lower number, you're not paying the 10% you do with the legacy IDR methods. You could be paying less. So a whole set of things there you need to look at. What people also have to realize is that when you use an IDR method or any loan repayment method, unlike some other things, you can, pick and choose or have two. Under the repayment methods, you can only have one repayment option selected. So you may have Parent Plus loans and you may have your own graduate loans. You may be limited to what you can use or do a repayment. So you only can have one repayment method. And that's been true for the longest time. But again, this is where the proper planning needs to be done. Just want to address who needs to be really focused. Again, I would recommend every person just take a look and make sure you're in the right place. Again, we have no income recertification since then. We have 7 million people still enrolled in SAVE that are going to have to get out at some point in time, and you might as well make that decision going out. Now, from now until January, with the Parent Plus loan limits, anybody that's taken a gap year that graduated in 2025 high school class, and they're going to have to use the cost of attendance limits, they need to really think, should I go back to school and enroll? Because you have to have a Parent Plus loan in place for the spring semester to qualify for the 3-year runway. Any graduate students are in the same situation that have not enrolled. So maybe you have a child that's considering graduate school. They need to be enrolled in graduate school and take a Grad Plus loan, which is not going to be an easy thing to do before the spring semester. If these things don't happen, they will fall under the new rules, which will be, depending on the student, the to $20,000 in some cases. So per year. So that makes it a really big deal. And then any Parent Plus loan borrowers with future debt needs. So that would be someone that maybe has, it's a married couple. They're maybe pursuing public service loan forgiveness for the Parent Plus loans, but they have children that are still going to be in school for 1 or 2 more years. Remember, I said only one repayment method is available. That family would have to do 2 things. They'd have to, 1, stop borrowing for the parent that's trying to qualify for public loan forgiveness, okay? And the new future loans would have to go under the second spouse for that to work. If you're a single parent, you're not going to be in a good situation. So again, these are the things that have to happen so that you're taking the debt on in the right structure so that you can be grandfathered into these 3-year runways that gives you that cost of attendance limits. Again, in January through early April, you have the people that are graduating. So the class of 26, you want to forfeit that grace period. We talked about that earlier, and enroll, at least compare what options you have for legacy planning. This is going to be really important. This would include both students and parents. This is another reason why the class of graduates of 26 need to complete a tax return for 25, even if they have minimal to no income. I would still recommend it. They will then have a 0 payment for that year. Again, everyone should submit a 25 tax return and do it the right way and do the proper planning to see what repayment options are going to be available to them based on their tax filing status. So this wraps up what we're doing there. Hopefully you've understood the different types of forgiveness and the details behind getting this. We hear all this, simplification, and you just get to, qualify for loan forgiveness and this. As you can hear and see, that it's not really that simple. As I said, you have to be using an income-driven repayment method. We're going from 5 repayment methods that are IDR to 1 in the new world. As you see there, the debt structure, as I talked about at the very beginning, if you think you're going to be paying for your child's undergraduate degree and get loan forgiveness, that is unlikely because the numbers just don't work. You saw that the tax planning and pre-tax deductions are all critical in your decision making here. This is where we're coming into open enrollment for many companies. To do the right planning, maybe we should move all the pre-tax adjustments over to the borrowing spouse if only one has debt. And even if we saw an article the other day, there's some misinformation. They try to simplify the process, but we're seeing more and more people, typically as a general rule, if both have student debt and they're both qualifying for, say, public loan forgiveness, married and joint will typically work because the debt numbers are usually about the same. But if there's a discrepancy between either income or their debt numbers, filing married and separate, even though they're filing joint will be more tax efficient, that may result in a better analysis. So again, this is really important. And then the people that are qualifying for that tax bond, whichever repayment, they're going to go to that IDR forgiveness or end of term forgiveness, need to be planning for that because that is a IRS tax exposure that you will have. So I hope you found tonight's information helpful. Again, the recording, someone's asking here, the recording will be, if you've registered, you will get an email about that after the program. And it should be, I think, by tomorrow morning, actually. And then I just hope everyone has a nice Thanksgiving, and we'll be spending it with family. My daughter coming in from Pittsburgh, but hopefully everyone can enjoy it with their family and friends, and just be safe if you're traveling. Again, thanks so much for joining us tonight. If you have any questions, please use our email there at support@payfored.com. And